Good morning, good morning, good morning. Today is Tuesday, April 23rd, 2024. Just doing a real estate tap in with you for today. So, a couple of things caught my attention. I'm going to attach the link to this report. It's like a mortgage report that goes back, they do it each month, and this was March's report that came out. And I think that if you're interested, you could take a look at it. It's not long, it's not tedious to read or anything like that, but it just gives some highlights as to the mortgage industry. There are a lot of homeowners that are in foreclosure and what they call serious delinquent, meaning that they're more than 90 days behind. But they are being protected by the servicers in the bank. A lot of these properties are still in forbearance, a good percentage of them. Some of them are in bankruptcy, and the other category is loss mitigation. So they're trying to work out some type of either short sale or some type of modification on their loan. And this has a big effect on this current market because if those homes were to obviously probably go to foreclosure or be moving down that line, maybe more people will be looking to sell because they probably have some equity in the property just based on when they bought it. Obviously, even if you bought it 3 or 4 years ago, you might have some equity in the property. So um, but because of this election year and everything like that, they're really not going to have too much stir up in this real estate market in terms of it having a downturn probably until after the election or as we get closer. But I can't see that happening as we get closer. They'll probably into 2025. So but the point is that there are a lot of people out there that are still having issues. And what we do and what we try to do on the note side of the business is help those people by using private money to be able to get people out of their situations and be able to take over a lot of this low interest debt. That's really the key in this environment that we're in right now, is to be able to, you know, with private money or with, cash or whatever you want to call it, be able to take control of low interest rate mortgages, because we're in this high interest rate environment. And I can't see any way that it's going to go back down to the 3 and 4%. Maybe it'll get to 6. You know, in the best case scenario, you might see it get down to 5 or 5.5. But I don't think anyone will tell you that interest rates are going to be, for homes, are going to be back in between that 2 to 4% like they were. So if you can get your hands on one of these low interest rate loans and then be able to offer seller financing at a higher rate, you can make yourself a nice spread there. And then obviously, we take the people through the qualification process, make sure that they can afford the home, and it becomes a great investment on both sides. Somebody can move into that property and then hopefully build up equity over time. And then you, as the investor, we have amortization working on our side, over the years, as that person pays down that underlying mortgage, with having a higher mortgage and interest rate. So it's a nice spread there. Can build a lot of equity and some nice payoffs down the line. So that's what we are trying to do. Obviously, we need as many people as possible that may want to fund these deals because they're out there all across the country. We look in some of these more affordable markets and some of these more foreclosure friendly markets in case there is a problem. We don't anticipate there being a problem, but you always have to prepare for worst case scenarios. So that's the key. If you can, get someone and be able to control their 2.5, 3.5, 4% interest rate for the next 20 plus years. That's the value with real estate right now, and that's what we'd like to do. So if you're interested in learning that or becoming a part of that, you can make a comment, reach out to us, and we can talk a little bit further about it. So but that's what caught my eye is that these statistics on the default and delinquency rates right now. And then also what caught my eye is that a lot of what's keeping this market, in terms of prices going up, is in the more expensive homes. I would say things over like $500,000 and up. People are buying in those ranges because they have that type of money. $1 million properties and things of that nature are selling. And so when you look at the continuing rise in it's continuing to go up, the price of homes, but a lot of that is because I think a lot more transactions are happening in those higher price ranges. So it's just becoming more difficult for people in the middle class and obviously below middle class to be able to afford a home in this particular market. So a lot of the the sales prices, plus 400,000, 500,000 going up to $1 million and over $1 million, all the properties, that are selling. So that's something to keep an eye on, because if there's any type of change, with employment, how much more is that going to affect that middle class, or what is considered to be middle class, and their properties. So just something to kind of keep your eye on. I would pay close attention to the unemployment rate. If it does start to tick up over 4%, that's going to be an opportunity to be able to help some people, because they're going to have to do something with their properties. And the way that we do it, by taking over that debt and structuring it, makes a lot of sense right now. So if you want to know more, like I said, just reach out, ask questions, and we'll get them answered for you. And hopefully, we can work together and, take advantage of some of these opportunities out there, because they are out there right now. So, all right, everyone. I'll talk to you soon. Have a great day.